Dear SBR students, I'm Abil Ahmed, SBR expert. Let us quickly discuss accounting of compound financial instrument. Assuming ABC company has issued a convertible bond. So it is the responsibility of ABC company to split that into debt and equity component. According to IAS 32, debt component is simply equal to the present value of all future cash flows. Sum of that is your debt component. From the total proceed which your company has raised, we'll deduct the debt component. Balancing figure is going to be simply equity component. Situation number 2 of compound financial instrument. There is a possibility under IFRS 2 share-based payment that organization has entered into a transaction where company has given the option to, let's say, their employees, either to ask the consideration in the form of, let's say, either to settle the transaction in shares or equity. Company has given this option to the employees. If this is the case, it is a compound financial instrument. Now the question is how to split into debt and equity component under IFRS 2 when option is with the counterparty and counterparty is your employees. They are your employees. So very simple. Under IFRS 2, all you need is just first calculate what is the fair value of equity alternative on grant date, assuming $60,000. Then calculate what is the fair value of cash alternative on grant date, assuming it is 55. 60 minus 55, 5,000 is your equity component number one. Number two, this 5,000 equity component value does not change. It's not going to be changed. Plus this 5,000 equity component will recognize over the vesting period. Second, the debt component on each reporting date we have to remeasure. Third, when we'll be recognizing the double entry remuneration expense, debit, equity and liability component credit, that remuneration expense due to IFRS 18, we have to show under operating section. The last situation of compound finance instrument, again, that relates to IFRS 2, assuming company has given the option to the supplier. Supplier can ask the consideration either in equity or cash. Under IFRS 2, again, that is a compound financial instrument, but the question is, if the counterparty is a counterparty, they are not your employees, then how to split the compound financial instrument into debt and equity component? Again, it's very simple. On transaction date, the day we are receiving simply goods from supplier, let's say the property, plant and equipment we have received on whatever is the day we have received the property, plant and equipment, the goods, the fair value of the goods the day we have received, it is assuming $10 million. From the fair value of the goods received, we will deduct what is the fair value of cash alternative on the same day, the day we have received the goods. Let's say fair value of goods which we have received is $10 million and the fair value of cash alternative on transaction date is $9 million. So 1 million is your balancing figure, which is an equity component. Again, the equity component value will not change, but when it comes to debt component, on each remeasure, on each SOFP date, we have to remeasure the debt component. In day one, the day you have received the property, plant and equipment, the double entry is going to be property, plant and equipment debit by 10 million, debt component credit by 9, and the equity component credit by 1. So subsequently, on each SOFP date, only the debt component will be remeasured. That's it. Thank you very much. We have quickly, I would say, discussed compound financial instrument under 3 different situations. Thank you very much for listening this concept building video.